Hello.
Hello.
Good. Good afternoon. Good evening. It should be evening.
Yeah, it's 7 p.m. here. That's right. Thank you.
We're almost at the same time zone.
Yeah, what time is it at you now?
Here it's 6:48 p.m.
Oh yeah, then it's exactly the same. Exactly the
Okay.
same. Yeah, almost 7 p.m.
All right. That's great then. How was work?
Yeah, as usual, as usual. I mean, my goal is definitely to become a full-time trader someday, and I really hope this will become true for me at some point, and this is why I'm doing this. And I was really happy to have found your lessons and your teaching, and I've gone through all of your course, and it was really good. I really liked it.
Okay. All right. Wow. Thank you so much. Thank you. Thank you. I'm sure you learned a lot. You had some good time learning.
Yeah, yeah, it was really good. I really enjoyed listening to your risk management part, and in the structure market structure part, you said you wanted to do a separate course also on market structure only. Is this still something you're planning to do, or is it this what is included here already?
Okay, I have a market structure part which is just which I've already recorded.
Oh,
Yeah,
I see, I see.
it's already there. Already there. So it's just a matter of maybe you're having access to it. But again, that shouldn't be so much of a problem because
Okay.
we are going to go through the same things that you went through. Okay. Now this
Good.
time
Yeah,
around,
yeah, that's
we'll
good.
go through it together with my guidance and my explanations so that in case there are some areas where maybe you didn't understand properly, you have that opportunity to ask questions and I'll be
Mhm.
able to clarify and be able to explain.
Yeah, perfect.
Yeah. Okay, so like you saw in the course, when much of my content, when I begin to teach, I don't usually assume that you, I don't assume that you know how to trade. Okay, so I just want to begin from the very basics and then we begin to
Mhm.
build from there. In that way, it really helps somebody to understand the whole concept in full and in details.
Yeah, that's absolutely okay. I mean, I always like to repeat things. My trading or learning how to trade journey is rather long, and I try to do something in trading, but to be honest, most of the time I fail to see good setups, and I fail to, yeah, most of the time also I don't have the time to trade because I'm at work, and this is one of my problems, and I want to be absolutely sure what trade to take, and sometimes I end up waiting for the second, third, fourth, fifth confirmation, and then the trade is already on its way and is gone for me
Yeah,
because
yeah,
I was not really confident about what I'm doing.
yeah, I understand. I've been there. I know that feeling. I know that feeling.
Mhm.
I've been there where you have so much to look at, so many factors of confluence that you need to put together before you realize it. The trade has already gone and you have been left behind.
Yeah. And I don't
Yeah,
want to jump into a trade because this would also be not that good to do.
yeah. Okay. All right. So, well then, can almost assure you that you are going to get um some good mentorship
Mhm.
and I'll be patient with you. One thing that I don't so much encourage, more especially those that I've been working with and have been helping, improve their trading skill, is I don't really encourage somebody to be so quick in trying to make money. All right, patience
Yeah.
pays in trading. So the more patient you become in acquiring the right information and the right skill set, the more profitable you will become once you begin to apply that knowledge on your trading. So I just want you to be very patient, because it will seem boring at first, but I can almost assure you that you are going to really get the best value. All right. Yeah,
Good.
in this
Yeah.
context. Okay. So let's get started. So the first thing that we are going to start with is market structure, and I'll explain market structure in depth. I'll explain market structure in depth. So market structure. Oops. All right. So what is market structure? So the definition that I have of market structure, and I want you to pay attention to some of the things that I'll be explaining and mentioning. All right.
Yeah.
So yeah. So the definition that I have of market structure is market structure is the foundation of every market. Now, in this case, we are limiting ourselves to Nasdaq, but what I'm going to share with you is a concept that is quite universal, and it can be applied on any asset class that somebody would wish to trade. So market structure is the foundation of the market. So every market, all right, has a structure. So it is a framework of every market. It is the skeleton of the financial market. So a good understanding of market structure is something that is going to elevate your trading beyond your expectation and beyond your belief. And when we talk about market structure, there are a few rules that you have to understand, and also just few properties that you just have to understand in order for you to be able to know what direction the market is heading, and also what you are supposed to do as a trader in order to capitalize and also look for some trading opportunities. So we know that the market is made up of three types of conditions. So we have three conditions which exist in the market. So you can say three conditions which exists in the market. So number one, what we have is we have uptrend market. Then number two, we have downtrend market. And then the last one, we have a ranging market, or a consolidating market. So a ranging market. Now, each of this market has got what I call properties, or rather rules, has got properties or rules that we can use to qualify the market. All right, it has got properties or rules that we can use to qualify that market. All right, so now the first thing that we need to look at is an uptrend market. Now, what is an uptrend market? An uptrend market is a series of higher highs and higher lows. All right, that's an uptrend market. So when we look at an uptrend market, what we're looking at, a market that is creating a series of higher highs and higher lows. So the key word in this market is the word a series of higher highs and higher lows. That's the key word. A series of higher highs and higher lows. A series of higher highs and higher lows. So what we have here, we have a low, a high, a higher low, a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and a higher high. Just to make some few annotations right here, you can say we have the low right there. Then we have the high right here. So this is going to be our high. Then we have the higher low right here. So this one is going to be our higher low. I want you to enjoy this lesson, okay?
Yeah, good.
All right. So right here we have a higher high. Okay, just a moment, I'm coming. I'm back. So we have the higher low right here. And then price pushes to go and create the higher high. So let me just get this higher high, put it right there, and also put it right there. And also put it right there. Then higher low, put it right here. Higher low, put it right there. Now, why is it important that we have to go through this seemingly basic information? One thing that I've discovered with trading is that the secret of trading lies in the basics. That's where the secret of trading lies. So a good understanding of market structure, like I said, is something that is going to elevate your trading beyond your belief. Okay, so here we have an uptrend, as you can see right here. So we have an uptrend. So we have a low, a high, a higher low, and a higher high. All right, that is an uptrend. And we can see that price continues to do what? To break structure to the upside, creating higher highs and higher lows. Now, while we are looking at the uptrend, okay, what are the properties of a trending market? All right, or what are the properties of an uptrend market? So we're going to say properties of an uptrend market. Okay, so these are the properties of an uptrend market. Number one, higher highs, or we can say higher highs. And number two, want to see higher lows. These are the properties of an uptrend market. So in an uptrend market, what we want to see is the market should constantly create what? Higher highs and higher lows. Higher highs and higher lows. So if the market is not doing that, then it is not an uptrend market. It is not an uptrend market, okay? Because an uptrend market can only create higher highs and higher lows. These are the properties of an uptrend market. So it can only create higher highs and higher lows, all right? So if it doesn't do that, then it's not an uptrend market, all right? Now,
yeah, but sometimes it can grab some liquidity a bit below and then continue.
Exactly, and we're going to deal with that.
Okay.
All right, I know all those things, and we're going to deal with that, but I want you to follow me step by step, because sometimes it may be confusing to start looking at, okay, what is it happening? This is why I want to give you the properties so that you look at the properties religiously.
All right, yeah, that's good. That's great, yeah.
Okay, all right. So liquidity, it will come in later in the future, and we'll also deal with liquidity like extensively. Okay. All right. Now, so these are the properties. So if the market doesn't do that, then it's not in an uptrend. All right. So if it doesn't create higher highs and higher lows, then the market is not in an uptrend. That is a thought that must be fixed in the mind, and you need to work with that. Now, what are the rules of an uptrend market? Because if we know that the properties of an uptrend market is price should give us higher highs and higher lows, then what are the rules? So we look at the rules for an uptrend market. Okay, so what are the rules? Number one, we want to break highs. All right, break of highs, or break of highs, say break of highs, which is BOS, can just put in break of highs. And number two, we want to respect of lows, which is higher low. All right. So we want to break the highs and respect the lows. Now, why is this information very important? All right. So for a market to constantly remain in an uptrend, we want to see the market break highs and respect lows. We want the market to break highs and respect lows. So we have a high, a low, and then we have a high right here, and then we have a higher low, then we have a higher high. All right. At this moment, we have a confirmed trend. And again, when we talk about confirmed trend, again, we'll deal with how we can look at what is a confirmed trend and what is a non-confirmed trend. So we have a confirmed trend, and after we have a confirmed trend, then the market will be looking forward to a market creating what? A higher low. So if this market should remain uptrend, the first thing is that we need to look at the properties. The properties must be higher highs and higher lows, and the rules. What are the rules? The market should constantly break highs and respect lows. All right, so the market should constantly break highs and respect lows. So you can see that the market break this high. Okay, it broke this high right here, and price then pulled back to create a higher low. But then when price created the higher low, it did not break below this higher low. All right, so it constantly respected this higher low, meaning that it has respected the rules. All right, it has respected the rules. It broken the highs, respected the lows. All right, what about here? We see price breaks the high right here when it traded above this higher high, then market pulls back and doesn't break below this higher low. Again, the rules are respected. Again, here we see price breaks this high, all right, to create that new higher high. Then what happened? The market then pulls back, all right. As it pulls back, it doesn't trade below this low, it maintains this low, meaning that price has respected the higher low. All right, so the uptrend will cease to be an uptrend the moment the market does what? Violate a rule. So once the market violates a rule, for instance, price comes in this way and runs this higher low down here. So once the market runs the higher low down there, it is not an uptrend. All right, it is not an uptrend. Before we even start thinking of whether it's a sweep of liquidity, because when we come to the subject of liquidity is a matter of subjectivity. It's not an objective look at the market. You understand? It's subjective. Okay, it's a subjective look at the market, because we do not know whether that is going to be a sweep of liquidity or it's going to be a complete reversal of the market. Right. But then what is going to help us to know whether we have a sweep of liquidity or a complete reverse of the market is when we look at rules for, I don't want to give you many rules where you start thinking, oh, this guy is giving me a lot of rules. Rules for a confirmed trend. Okay, this is something that has really helped me to remain objective whenever I'm looking at the market. So rules of a confirmed trend is, we want to see, number one, we want to see two highs, and number two, we want to see two lows. Now, this is very important. This is very important because of the definition of a trend. We said a trend is a series of what? A trend is a series of highs and lows. All right. So for us to have a trend, we want to see we have to see a series of highs and lows being created in the market. All right. That's what we want to see. So we can never have a trend where the market has just created one high and one low. That's not a trend. Okay, it's not a trend. So for us to have a trend, and a confirmed trend for that matter, we want to have a high and a low, and the second high higher than the previous high, and the second low higher than the previous low. So for example, in this uptrend market, we have, this is the beginning of the trend. Let's say the market is just being introduced in the market for the first time. This asset, let's say it's Bitcoin, it has never been introduced in the market before. It's just entering the market. So it will always start at the lowest price, and then buyers will begin to do what? Begin to place their bids, and price will start pushing to the upside. Then after the market creates that high, all right, there will be that period where the market will need to pull back, which we call the exhaling, where the market inhales and exhales. So there'll be that exhaling aspect where the market has to pull back. So once the market pulls back, all right, the purpose of this pullback is to respect this low right here. All right. But if a trend is to be formed, exactly, if a trend is to be formed, we want to count this as the first low that the market printed, and this is the first high that the market printed, and then this is going to be the second low that the market printed. And then if market goes all the way to create another higher high, this then becomes the second high that the market prints. So if we have two highs and two lows, all right, then we are going to have a trend. So a trend is
so the origin point you also count as a low.
which one?
Yeah, you said you want to have two lows and two highs, and that means this is the origin, and this already counts as a low, as the origin point as a low.
It's a one. Yeah, it's
okay,
one.
okay. Yeah, and after this high, I mean, we surely expect a pullback, and we could get in after we see that
Exactly.
low
So this
being formed.
This is where we are going to enter. Now we have a confirmed trend. Okay.
Right.
A confirmed trend is basically an ABC kind of a movement. All right. If we look at the Elliott wave, so the A, this one is going to be our A, the pullback is going to be our B, and then this leg is going to be our C. So once we have ABC move in the market, then you have a confirmed trend. Okay. You have a confirmed trend. So in that, you have two lows. This is the first low. This is the second low. You also have two highs. This is the first high, and that is the second high. So once you have this, then you have what? A confirmed uptrend. That's now a trend. It's confirmed. It's a trend, meaning that on the third pullback, all right, or on the second pullback, because this was the first pullback, then on the second pullback, you'll be looking for what? To take entries. So you'll be looking to take entries right here now that you have a confirmed buy trend. So you'll be looking forward to looking for some buying opportunities in order to push the market to the upside. All right. Okay. So now once the market, it has been consistently creating higher highs and higher lows, right? The market has been consistently creating higher highs and higher lows. And we know that if the market has been consistently creating higher highs and higher lows, we are in an uptrend. No doubt about it. All right. The momentum is to the upside. All right. And we are looking forward to buying opportunities. But again, we do not know whether the previous higher low is going to hold or it's not going to hold. But what we have based on historical data is that the previous higher low has been holding. Why? Because price, according to the rules of an uptrend, is respecting the lows, and we expect the lows to hold. You get it? Now, the moment market breaks this previous higher low or the recent higher low, that led to the creation of the new higher high. Once price breaks it, what does that mean? What that means then is that the market is neither uptrend nor downtrend. All right? It's neither uptrend nor downtrend. And this is very, very much important because sometimes we may start thinking to say, okay, this is a grab of liquidity. Yeah, it is a grab of liquidity, but it could also mean that the market wants to reverse.
Yeah, I understand.
You understand, right? So it could be a grab of liquidity, but it could also mean that the market does what? Wants to reverse. Because even a reversal, that's how it happens, all right? That's how it happens. So sometimes even if the market takes out 3 lows, all right? 1, 2, 3, all right? This is still an unconfirmed downtrend. Why? Because for a trend to be formed and a trend to be confirmed, we go to the rules of a confirmed trend. What do we want to see? 2 highs and 2 lows. So at this particular moment, we only have 1 high and 1 low. All right, we only have 1 high and 1 low. So now when we factor in the issues of liquidity, this is where we are going to say this was the sweep of liquidity right here. All right, in order for price maybe to mitigate, an odd demand zone that was not mitigated for price to continue pushing to the upside. That is one of the possibilities. All right, it's not always certain that that's what the market is going to do. It's one of the possibilities, and that possibility, the probability of that possibility happening is 50%. All right, it's 50%. So you can't, the fact that in the previous, maybe in the previous scenario it worked, does not now make it 100% correct that even in this scenario it's going to work. And this is where I've come to observe that many of smart money, concept traders and all these guys, they tend to generalize concept that generalize concepts that are totally subjective. What do I mean totally subjective? Because how you interpret liquidity in the market comes down to how you are looking at the charts. You get it? It's not always objective that once you see this kind of scenario, then the price will do this and regain its original trend. It's not always, but then there's a high probability, at least the chance is 50-50, but based on historical data, there's a higher chance of price resuming its original trend after this sweep. All right, there's a high probability, because when we look at the historical data, the market had been uptrend. All right, so we had been uptrend and we maintained an uptrend momentum where price was breaking highs and respecting lows until this happened. So this then it gives us, if we have a confirmation on the lower time frame, let's say right here we have something like a change of character down here, then we can say, okay, we're going to take this buy to the upside, but then aiming for this target, all right, would be very risky, because at the same time the market might be thinking of doing what? The market might be thinking of reversing the trend and, you know, confirming that now it wants to go bearish.
Yeah.
Okay, so this is why this kind, it's a sweep. At the same time, it could be a reversal. It could be the beginning of a reversal. So mostly whenever you see that happening in the market, this is why you now have to be open-minded. You understand? You have to be open to both buys and selling opportunities, provided there is lower time frame confirmation. Because so we can't just hold on to a bias that, okay, what is going to happen is that the market will continue pushing to the upside and it will give us a new higher high. No, even though that is what may likely happen because of where price is coming from. So if we look at the higher time frame bias and look at the trend, we would say the trend has been uptrend. All right, the trend has been uptrend. So based on the previous data, okay, we can therefore lean towards an uptrend move, all right, more than a downtrend move. Why? Because for a downtrend to be established, we still need another high and another low. So we only have one high and one low right here until price then pushes, creates another lower high in order to give us a lower low. Then we have a complete confirmed downtrend reversal. Okay, does that make sense?
Yeah.
Okay, all right. So that is what we're going to see on an uptrend market. Now, the other type of a trend that we're going to have in the market, we have already looked at the uptrend, the basic idea of the uptrend market. So the other type of a trend that we are going to have in the market, again, it's a downtrend market. And a downtrend market is just like an uptrend market, except the market is pushing to the downside, creating lower lows and lower highs. So let's say the market creates that high, then it drops to create this low before they pull back to create the lower high. Then the market pushes to the downside. So like I said, for us to have a confirmed trend, we need two highs and two lows. So already what we have right here is a confirmed trend, even though it looks like an N or a Z flipped, but what we have, it's a confirmed trend. And this is, your eyes should get used to seeing something like this, all right? Okay, so we have, I'm not going to annotate much on this one, but you can say we have a high, a low, a lower high, then a lower low, breaking structure. So right here, you can say that we have broken structure to the downside. Now we are in a confirmed trend. And the next thing that we'd now be looking for is to see the market do what? Give us a pullback in order for us to continue being in a bearish trend. And what are the rules of a bearish trend? Okay, so if the rules of a bullish trend is we want to see the break of the highs and the respect of the lows, then what are the rules of a bearish trend? So rules of a downtrend. So rules of a downtrend is number one, we want to see the break of the lows. So break of the lows. Okay, I'll just say BOS. And number two, respect of the highs. Okay, respect of the highs, then I'll say lower high. Okay, so respect of the highs, which is the lower high. So rules of a downtrend. So rules of a downtrend, we break the lows, we respect the lower high. So we have already broken a low, all right? And in order for us to maintain a downtrend move, what do we want to see? We want to see price to come back here, respect that lower high, then continues to push to the downside. Again, price should come back here, respect the lower high, and continue to push to the downside and until the downtrend cannot continue anymore. So for as long as the market continues to do this, then we are going to continue looking for some selling opportunities until a sale cannot work. So continue selling in a downtrend until sales cannot work anymore, and continue buying in a downtrend until your buys cannot work anymore. Okay, that's the religious way of trading, and that's how I approach the market. For me, until the buys fails to work, that's when I'll change my bias. For as long as the market keeps me giving me buying opportunities, I'll continue buying in an uptrend. All right, so we have a lower high and lower low. We break structure, we pull back, create lower high, and we create lower low. Again, we pull back, we create lower high, then we break structure to the downside and create lower low like that. So again, a downtrend, we are respecting high. So we have one high, one low, second high, and second low. We are confirmed downtrend, then we'll be looking forward to selling the market the moment price pulls back to come and respect the lower high. So the downtrend is going to be a downtrend for as long as price does not trade above these highs. All right, so we don't want to see the market trade above these highs. No matter the situation, if you are an investor and you're selling the market, you don't want the trade to start playing above your entry. You see, because you understand that once price begin to trade above my entries, then I'm not going to be good. My account is going to be in negatives. So you want to maintain the downtrend, and you want to be selling hard the moment price gets near to your entry. If you had the capacity to move the market, then you'd want to even sell hard. Okay, so this is just a basic example and of the market structure, both uptrend and downtrend. And then the last condition which the market exists in is what we call a ranging market. And again, a ranging market is something that is very important because it tells us what we should do next. Because in most cases, when you're trading a ranging market, many, and I've observed, would want to participate in that ranging market. One thing that you need to understand is that as we are trend followers, meaning that we trade the trend, we ride the trend, we don't really do anything, necessarily do anything when the market is ranging. So what is an example of a ranging market? So let's say we were in an uptrend, price was creating higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, then price fails to create a new high. And price is now stuck within a range, all right, and it keeps on creating new highs, and it keeps on creating equal highs and equal lows. Let's say price is right here, all right. So previously we can see that the market had been in an uptrend, creating higher highs and higher lows, and they have said that the market spends most of its time in a range or in a consolidation. Okay, so we have a break of structure. As you can see, price is pushing to the upside, giving us new structure. Now, when it comes to looking at the market structure and also looking at the range, no one knows when the market is going to get into a range, and no one knows how long that range is going to last. All right? No one knows when the market is going to get into a range, and no one knows when that range is going to last. So in most cases, what we need to do with the market is react to what the market is doing rather than predict what the market is going to do next. Like Mark Douglas said, you don't need to know what the market is going to do next in order for you to make money. So you just have to wait for the market to give you direction, and you react to that direction. Okay, so if we look at the market right here, we have been bullish, and we were confirmed bullish because we had one high, one low, one high, second low, second high, and then price continued giving us higher highs and higher lows. And you would obviously be looking for some buying opportunities the moment price begins to pull back to these areas. So you'll be looking for buying opportunities, maybe targeting that high. But again, you would also be expecting that price should break above this high right here. Let's say price should break above that high in order to do what? In order to create new highs for an uptrend to continue. But then what happens is that price fails to create a new high, but instead it creates an equal high. So as we can see right here, price pushes, right? And then it creates a high, fails to break above. Then what happens? Price then goes back to the entry or to the origin of that move. And then again, price fails to break that area, and then it begins to push to the upside to go and do what? To go and maybe, obviously, it may create a new high, but then it fails, and then price begins to just play around this range. So what we're going to have now is a ranging market. And the rules of trading a ranging market is, in most cases, you don't have to do anything when the market is ranging because you want to trade with a trend. All right, our goal is to look at where is the momentum. When the momentum is kicking in, we want to buy the market with the market makers. All right, so once the market is trapped into a range, like I said, no one knows how long the range is going to take. Sometimes it may take a few days, sometimes it may take a few hours, depending on the time frame you are looking at it. Sometimes it may take a few months, few years, depending on the time frame that you are looking at it. Okay, but once the market gets into a range, we want to wait for a breakout of the range and an establishment of a trend. So we had a trend until the market entered a range. So our trend was until the market entered a range. So right here, we can say we had uptrend, all right? Okay, uptrend, okay? Now we have a range. So we can say this is a consolidation. Hope I'm not too fast.
No, it's okay. It's good. It's really good.
Okay. So here we have a consolidation. Oh, consolidation. Okay, so we have a consolidation right here. And also, yeah, so this is a consolidation. So we had an uptrend, a consolidation. So what do you think is going to happen next? All right. Many, and I've been a victim of that, was to try and buy the market somewhere right here. Let's say, trying to buy the market somewhere right here and expecting that the market would break out and push the market to the upside. After all, that's a good area to look for some buying opportunities. So I'd love to buy the market from there. All right. Okay. And why am I doing that? Because I would look at where price is coming from, say, oh, okay, we have been in an uptrend. So obviously, it's much easier for an uptrend market to do what? To continue. So one thing that you need to understand is you can treat this occurrence here just as you treated the sweep of liquidity. All right. So it's more like a reset in the trend. It's more like a reset in the trend. All right. So when the market begins to consolidate, it's more like it is resetting itself to begin a new trend, either uptrend or a downtrend. Okay. That's what I look at a consolidation in the market. It's more of a reset in the market, either for the market to continue with an uptrend or the market to reverse and create a downtrend. So what we want to see now is the reestablishment of a trend. So if price breaks out, okay, all right, if price breaks out, many traders' expectations, except those who trade breakouts and all that, but many, including smart money guys, would want to say, okay, so now we have a high, a low, a high, a higher low, higher high, higher low, higher high, higher low, higher high. They will treat this as a higher low, and they say higher high. And what they'll be looking forward to doing is to wait for a pullback like this and buy the market. Okay, that's what many traders will look for. All right, they say, okay, we are now broken out, so let's wait for a pullback. And then once a pullback happens, let's look for an area of interest. Let's say an order block or a demand or anything. All right, a sweep of liquidity or anything that we can look for in order to get our buys or in order to get into the market and start looking for those nice buying opportunities to the upside, which is, yeah, it works only to some extent, but it is the wrong approach to trading the market. All right, because
okay.
Yeah, because at this moment, the trend has not yet been fully established. Remember, like I said,
yeah, I understand now. Okay, yeah.
you understand now, right?
Yeah.
Yeah, because this is a reset. All right, it's a reset. So the market from here, from the start here up to where the consolidation began, it was an uptrend. Then the market began to reset. So here it's resetting itself. So once you say this is a higher high and I have to get on this one, you don't have a trend, because for us to have a trend, we are looking for what? 2 highs and 2 lows. So what you only have is 1 low and 1 high. All right, so you can't just come and get into this one. Why? Because sometimes the market can do this. All right, it sweeps the upside, it sweeps the downside, then it confirms the downtrend and pushes to the downside. All right, so there's this kind of a situation that would happen in the market, to a point where I start thinking, I don't know what I was doing. I would have waited a little bit, because by then it would have trapped you. All right, it would have trapped you. Trying to buy here, price will push down. All right, trap sellers, bring them up. When it has already trapped buyers, brought them down. So it is sweeping liquidity everywhere before the market reestablishes the trend and decides to go to where it's going. You get it? So this is why it's very important that you wait for a trend to reestablish. What is a trend? Again, a trend is a series of highs and lows. So what you're going to have is you have one low, one high, second low, and second high. Now you have an established trend in the market, and what you can do now is come back, price will definitely pull back and push to the upside to give you those entries that you've been yearning for. All right, one thing that many traders don't have in the market is patience, because of FOMO. FOMO really messes traders' minds, because they think the market is going to leave without them. Doesn't matter whether the market leaves without you. What you need to have is an abundance mindset, knowing that opportunities will never come to an end. The market has been in existence before I was born. I found it. All right, even when I die, I will leave it, and it will still be paying other people that continue trading. Even somebody who comes into the market today and stays into the market for 1 year learning, you'll still become profitable in the end. All right, so the most important thing in the market is patience, and always respecting the rules that you have created, which are part of your trading plan. All right, so this is what we're going to do. So we wait for a low, a high, a higher low, a higher high. Once this is established, again, it's an ABC pattern, ABC. Once that ABC is formed after a consolidation, then you can now take a trade and start pushing to the upside. All right, and start taking entries. And the reason why this is happening is because if price hasn't swept, all right, if price hasn't swept both the upside and the downside, then you have to wait for serious confirmation. All right, you have to wait for serious confirmation if that sweep hasn't happened. Because even when the market is sweeping, all right, it's sweeping, sometimes the market would act so crazy, more especially Nasdaq. All right, I've seen a situation where Nasdaq is just misbehaving, sweeping the highs and sweeping the lows without any proper direction, until now it decides to choose to pick a direction, reestablish the trend, then you join it, and you can catch some good trades like that. All right. So any questions about the 3 conditions?
No, that's really good. That's clear. Yeah.
Very much clear, right?
Yeah.
Okay, so the second thing that we're going to look at is, and by the way, this one, it will be just more focused so much on the theoretical side of things. So we'll still need to apply this information on the charts, but of course, maybe not in today's lesson, because I want to deal with the theory before we can go to the practicals.
All right.
Okay, so the next thing that we're then going to look at is we're going to look at the swing structure, all right? The swing structure. And when we talk about the swing structure, it's still market structure, but let's just look at what does swing structure mean. Now, these things, it's more like I'm just repeating the same things over and over and over and over, but there is something that is being built. We are building the market structure, understanding layer by layer. All right. So when you look at your market, you will observe that the The market that you see on the chart and the market that you see on textbooks, it appears to be different, because sometimes we tend to give you a perfect example of the market structure, such that when you go to the charts, you begin to have problems finding that market structure because it doesn't exist. You get it? And that's a problem that I had, because every mentor that I looked at, you know, even when I surfed on YouTube, they would give me a perfect example of the market structure, right? Perfect examples, flawless. But then when I go to the charts, I begin to struggle finding that market structure because it doesn't exist. They picked the best examples that they could give. You get it? So when we look at the market structure, we're going to say we will have, let's say we're going to have a high right there, and then price will begin to pull back. And then after the market pulls back, okay, then we begin to create a new swing structure. And it's very much important to understand, to be zoomed out in order to know what is it that the market is really doing. Very, very much important. Okay, so we have that higher high, and then something like that. Okay, so in most cases, when you're looking at the market, you're going to be confronted with a very complex structure of the market, all right? And we'll deal with all those things in this lesson. So you're going to be confronted with a complex market. But the most important thing that you have to understand is, you have to know is, what is your swing high and what is your swing low. So just by definition, I can say a swing high is a highest point in the market that creates a swing low. So I can say swing high is the highest, okay, highest point that creates the swing low. Okay, and you can say swing low is the lowest point that creates the swing high. Right, and everything between the swing high and the swing low is what we call internal structure. So everything between the swing high and the swing low is called internal structure. Okay, so it's called internal structure. So swing high is the highest point in the market, or it's the highest point that creates a swing low. And the swing low is the lowest point that creates a swing high. All right, so in an uptrend, swing lows lead to swing highs. Swing lows lead to swing highs, swing lows lead to swing highs, swing lows lead to swing highs. That is in an uptrend. In a downtrend, let's say I flip this. So in a downtrend, swing highs lead to swing lows. Swing highs lead to swing lows, swing highs lead to swing lows, etc., etc. All right, so let's begin with a uptrend and let's look at it. All right, so in an uptrend, now what we have right here is, we can see that price pushed, created that minor structure there, higher high, higher low, then created the higher high, then price pushed all the way to the downside and created the lower low, then lower high, lower low, then price put back in a complex way to create a lower high, then it created a lower low. So what does this mean? All right, the highest point in the market is a swing high. So you can see that this is the highest point that the market created, not this one right here, but the market created this highest point right here as the swing high. So this becomes your what? Your structure. All right, this becomes your structure. So you can say BOS, like break of market structure, like that. So that becomes your structure. I want it to be like this. So that becomes your structure right there. And the swing low is the lowest point in the market that leads to the creation of the swing high. So what is the lowest point in the market? It's this low right here. So this, as the market was pulling down, it came and created this lowest point. So once price created this lowest point, it never came back to it, and it left going to create a new high. So a swing high or a swing low is only going to be confirmed a swing low once price goes up to create a new swing high higher than the previous high. So this one is only a swing low after the market creates a swing high, all right, higher than the previous high. So if the market fails to create a swing high higher than the previous high, then that is not a swing low. It has failed to be a swing low. So a swing low only becomes a confirmed swing low after price breaks structure to create a swing high, because that's its job. A swing low should lead to the creation of a swing high, and the swing high is the highest point in the market.
Yeah.
You get it? Yeah. So again, what do we have? After we create this swing high, price begins to pull back to come and create a swing low. So we can see all this is internal structure: lower high, lower low, lower high, lower low, lower high, and lower low, and a lower high and lower low. All right, so we create this low right here. Now, according to the rules of our uptrend market, the market should respect the lows and break the highs. So once we create this low, this low here is not yet a confirmed swing high until we see, it's not yet a confirmed swing low until we see this swing high go. All right. So until the market creates the highest point in the market, this is not yet a confirmed swing low. So price then begins to create higher highs and higher lows, higher highs, higher lows, until we break above it, we create a new higher high. All right. Then we are going to say this is our what? Our swing low. And now we have a pullback, which you can see it's just one push to the downside, and price respects something in this internal structure to create a higher low. And then again, we see a market breaking structure to the upside. So again, what we're going to say about this area, we're going to say that was a swing high that was created, and then the market put back to come and create a swing low. Again, this is a swing low that is created, and then we see the market breaking structure to the upside to go and create a swing high. All right. Again, after the market creates a swing high, price begins to do what? To pull back slowly, all right, creating this internal structure to come and do what? To come and create a swing low. All right. Again, how are we going to know that a swing low has been created? We want to see price move away from this area, go all the way, take out that high which it had created in order to create a new higher high. So this is how swing low and swing high are created in the market. Sometimes you may use this understanding in order to do what? To look at the market. Maybe you're looking at the market on 1 hour, but you're trying to track the daily structure, or you're trying to track the higher time frame structure using the lower time frame structure. So it can help you to track the higher time frame structure using the lower time frame structure, because sometimes we become too zoomed in on the lower time frame that we tend to forget what the higher time frame is doing. So for example, we may become too zoomed in here that we start looking for selling opportunities, forgetting that the market, the overall direction of the market is what? Is downtrend. Or we can become too zoomed in into this pullback right here, looking for what? Looking for selling opportunities when the overall direction of the market is what? Is uptrend. So the overall direction of the market is this side, because we just had a higher time frame break of this swing high right here, creating a new swing higher high, and then price is in the pullback. So we can follow this pullback to the downside, creating lower lows and lower highs, and we can be taking some selling opportunities, forgetting that the overall trend of the market is what? Is uptrend. And that can cost us a lot. So we need to understand where the swing points are in the market in order for us to be able to look at or to trade the maybe zoomed in charts or the lower time frame effectively. Any questions?
No, it's clear. It's very clear.
Okay, great. So I'll just try to flip the chart instead of me having to
yeah.
Yeah, it's much easier. All right, so let's look at now the example of a downtrend. So again, when we look at the downtrend, what we have is price creates that high, then it pushes all the way to the downside, creates this minor high, minor low, minor high, and minor low right here. And then after price creates this low, then price moves away from that low, starts to create highs and lows and highs and lows until it creates that high. So until we break below this low, right, this is not going to be a swing high. It's not going to be a verified swing high. So what we want to see is price should come and attack this low in order for us to verify that this is going to be a what? A swing high. Right together. So now we see that price begins to push again to the downside, creating lower lows and lower highs in line with the original trend of the market. Although at this particular moment, a trend has not yet been formed, but we can see that the market then begins to push lower lows, lower highs, lower lows, lower highs, and lower low. Once we create this lower low, we want to see price move away completely from it. All right. So once this high manages to take out this low, then it becomes a swing high, a verified swing high, right? And we can see the market then creates this swing low. Then now this swing low must now lead to the creation of a swing high. So price again begins to pull back, as we can see, creating those complex structures or creating those internal structures as it pushes its way to the upside to go and retest this structure right here. And then from there, the market then moves away until we see price takes out this low right here. This high is not going to be called a confirmed what? A confirmed swing high. So for it to be called a confirmed swing high, it has to take out this low, because for as long as this low is still standing, price is still in this range from that high to this low, and we are not yet out of it. All right. So the moment price comes all the way and takes out this high, then we can see that now this becomes our confirmed swing high, and price then goes all the way to create swing lows. Sometimes price, like I said, it may react with any of the ranges, smaller ranges within that swing leg to the downside. So like in this situation right here, we can see that price was able to react with this price was able to react with this lower high right here, right? And this is where price reestablished its a higher low on the higher time frame, or its swing high on the higher time frame, in order for market to continue to go and create the swing low. Again, this is only going to be confirmed a swing low once the market takes out this lower low right here in order to create this lower low down here. And then again, we can see price from there begins to push to the upside to go and create the lower high, which is the swing high. Then after this swing high has been created, we want to see this swing low go in order to establish that this is a verified swing high. All right, so that is how swing structure forms, and swing structure, it really does help us to know, or rather track, where the market is going in terms of structure, or where the market is at in terms of structure, so that we don't get confused or we don't lose sight of what the market is doing. So like I was saying, there has to be a confirmation that the market has moved out of an established high. So if this is our swing high and price is coming down like this, right, the proof that this is going to become our swing low, all right, should be that the market manages to take out that high. So if price comes to this high, fails to take it out, and then price again begins to push to the downside, then creates this low. All right. Okay, so we had this high right here, which we were expecting that the market was going to attack and take out. So that was our high, and this was our low right here. Okay. And this was our low right here. So we had this low right here and that high. So let me just say, yeah, something like this. So that was the high that we wanted to take. So we are going to be trapped in this range from this low to that high. All right, this is going to become our range. And what is a range? A range is the distance between the swing low and the swing high. That's just a simple definition of what a range is. The difference between the swing high and the swing low. So we're going to have this low, that high. Price then pulls back to come and create a swing low. All right. Now this swing low pushes price but does what? Fails to take out that high. So this is not a swing low. All right. So we're going to say this is going to become our what? Failed swing low. It has failed to do its objective. So failed swing low. All right. Failed swing low. All right. It has failed to take out the high. Now price even, once it fails to take out the high, it even becomes weaker. And you can see price even took it out right here, broke it out. All right. But it was still respecting, let's say it was still respecting this low right here. Okay. So it was still, the market was still respecting, this low right here. As you can see, it has not yet broken. It's according to the rules of market structure. We are still uptrend for as long as we have not traded below this low. And this does happen in the market, such that sometimes you start questioning whether what you've been doing is correct or wrong. No, it's correct, except that you were looking at this is a weak swing low. Because
yeah, but one question to this. I mean, we said it is an established trend if we see two highs and two lows.
Yeah, exactly. So I'm assuming that there's already another low right here. Okay, that's the assumption. I know.
Yeah, but I mean, I would say this is a high and this is a high.
Which one?
This, and we broke structure here, as you said here, and this is a low, and this is a low. So at this point here, I would, if we follow the rules, then I would say this is a confirmed downtrend now.
Yeah, but again, it's not a confirmed downtrend. It's a confirmed complex it's a complex pullback. It's a confirmed internal structure downtrend. Okay.
Yeah. Okay.
Yeah, it's a confirmed internal structure downtrend. Now, look at this. Let's look at
yeah, I understand, because we are still inside this whole range between here and here.
Exactly.
Okay. Yeah. It is a downtrend on the lower time frame regarding this here, and
regarding that.
Yeah, exactly.
Yeah, regarding the pullback, it's a downtrend, but regarding the original trend of the market, it's an uptrend. Okay, because we are yet to break this. So this is also one of those confusions that will come into the market, where now you begin to wonder, okay, am I uptrend?
Yeah. You know what confused me was, you said this is a failed swing low. It is a failed swing low in regards to this one here. But it is, of course, it is not a failed low if I look at this low and then this low. Then this low has completely done its job because it broke the structure here. But this is only on a lower time frame.
Yeah, exactly. It's on the lower time. And here we had a change of character. You see, we had a change of character.
Yeah, exactly.
So meaning that what was supposed to be a downtrend, meaning that this swing, this pullback has come to an end and price should start pushing to the upside. So if you look at it in terms of swing structure, all right, this should have been a failed swing, because the target of the swing high, remember, the target of the swing high is to create a swing low. It has to, target of the swing low is to create a swing high. So it has to target this, all right? It has to target this.
Yeah.
So if now this higher low fails to take out that high, it is not a strong higher low. So once we start looking at strong highs and strong lows, it's not a strong higher low, because it has failed to do its job. Its objective was to take out that high.
But that also means that this one here is a failed swing high.
Yes. So this is a failed swing high.
Okay.
Okay. It's a failed swing high, meaning that it has, actually, it's not a failed swing high, because if we look at the overall trend, all right, it's I don't want you to start looking at this. Okay, this is going to now mess up what you're really looking at. I want you to look at the objective. Where was the recent break of structure in the higher time frame? We broke this high. You get it? Broke this high, we created that high. So this is a low, a high, a higher low, a higher high. What is this? It's a complex pullback. We'll look at complex pullbacks later. All right. That's
All
a
right.
complex pullback. What should be your bias? All right. In as much as you look at all these confusion that are happening right here, all right, you look at all this confusion. What would be your bias at this moment? All right. Now that we have taken out this low, all right. So now that we have taken out, this is a weak low, all right. It is an insignificant swing, all right. Same here, this is going to be an insignificant swing in the context of the trading range.
Yeah.
So in the context of this trading range right here, this low and that high, this is insignificant, that is insignificant. Even though it managed to take out this low, it becomes a swing high, all right, which is a minor swing high because it has taken out a low that was insignificant. So it becomes a minor swing high within a true swing high and a true swing low. So now what we need to wait for is to wait for maybe let's say a change of character where price then begins to do what? Let's say maybe where price pushes up, gives us a change of character right here, then it pushes to the downside, gives us an entry, and then price continues going up like that. So now, okay, just a moment, I'll mute. 1 minute.
Yeah, no problem.
All right, I am back. Are you there?
Yeah.
All right. So in the context of structure, right, then this now becomes our what? Our verified swing low. All right, so this then becomes our verified swing low. So you can say confirmed swing low. Why? Because it's the one that led to the break of this swing high, right, creating a new higher high. Okay, so that's how you can look at structure, and that's one of the best way to read the market structure. Right, no matter the confusion that is really happening inside. Okay, so you can see all this confusion was for the purpose that the market should continue pushing up. And what was this? This is where now, if we come back to the concept of inducement, this is where we're going to say this is what we call what? Inducement.
Yeah, but in general, we only have to look at this low and this high.
Yeah.
And all this here, all what happens here is basically just this and then going up.
Exactly. Yeah, it's just that. So this is where now, if we bring in, like I said, the concept of liquidity and all these things, this is where now that law is going to be considered as what? As inducement, and we'll be looking for price to come and mitigate something here, give us a change of character, pull back for our entry, and then we take a trade. You see, so it all comes, it's something that once you understand the overall picture, the overall direction of the market, all this confusion, like you said, it's just this. It's just this. We just did this right here, and we did that. That's all.
Yeah.
That's all. And that's what, you know, sometimes these guys, they'll make us get confused because they are trying to accumulate liquidity in the market. So in trying to accumulate liquidity in the market, they'll begin to create crazy structures to the point that you lose sight of what the market is really doing. Is it doing this or is it doing that, etc., etc. Now, we are going to now look at the concept of having looked at this concept. I want us now to upgrade a bit and look at the concept of what? The concept of we're going to look at the concept of strong structure and weak structure. And again, it may sound like we're just looking at the same things over and over, because why? We are trying to intensify, because each concept has its interpretation, all right? Has its interpretation. So right here, you can say we'll begin now looking at strong highs, lows versus weak highs, lows. Okay, so strong highs, lows versus weak highs and lows. Now, a strong high, let me see if I can write something here. The purpose of a low, and when I talk about a low, I'm talking about a swing low or a higher low. It's one and the same, right? So the purpose of a low is to
break
take, is to break, exactly. Let me use the word break, is to break a high.
Yeah.
Okay, it's to break a high. That's the purpose of a low. And if it fails, so it's to break a high. So a strong low breaks a high, and a weak low fails to break a high. Okay, so you can copy this and put it down here and say the purpose of a high
Yeah.
is to do what? To break a low, right? Okay, so a strong high, okay, breaks a low, and a weak high fails to break a low. Okay, so we have summarized. Okay, so the purpose of a low is to break a high. A strong low breaks a high, and a weak low fails to break a high. So the purpose of a high is to break a low. Okay. Oh, okay.
Yeah.
Okay, I've seen. So a strong high breaks a low, and a weak. Okay, repetition. All right. So a weak and a weak low. A weak low fails to break. I mean, a weak high, right?
Yeah.
High.
This one's high.
A weak high fails to break a low. All right. So the purpose of a high is to break a low. So a strong high breaks a low, and a weak high fails to break a low. All right. So in an uptrend, while we have, if the market continues to break the highs, so at this moment we have a confirmed trend. I'll always be pausing once I do this so that it gets into your mind. Say, okay, this is my confirmed trend. So at this point, we have a confirmed trend. We have a low, a high, a higher low, a higher high. It's a confirmed trend. We are bullish. All right. And at this moment, we already have the break of the high, which means that price is confirmed trend. It's confirmed. It's putting up now strong lows. So this low is strong because, let's begin. The purpose of this law is to create a high. So that's created the high. It has achieved its objective. The purpose of this high right here is to take out this law. Okay, it's to break this law, right? That's the purpose. So if this high fails to break the law, it becomes weak, right? And therefore it is going to be targeted, right? It becomes a weak high and it's going to be targeted. The purpose of this law is to take out the high. All right. So now, if this law manages to take out that high, it becomes strong and protected. All right. Meaning that the moment price comes to this low, we don't expect this low to fail because it has already done its objective, achieved its objective by taking out that high. That's the whole idea. Okay. So let's continue now drawing. Okay. So now what happens is that price comes all the way down here. All right. It fails to take out this low. We say this is protected low, all right, because we can see that this low managed to take out that high, and as it managed to take out that high, it became protected, it became strong. So we expect the market to come and not break this low. All right. So if price respect this law, then we are saying that, okay, now this law is now confirmed protected and it has led to the break of structure. All right. So this law is the one that fueled this move to go and take out that high. All right. So now this high right here failed to take out this low. Therefore, this high is going to be what? It's going to be weak.
Yeah.
And then again, price pulls back because now this law here managed to take out that high. This law is protected. This law is strong. We don't expect price to trade below it. We expect price to bounce the moment it reaches this area because it is protected. So there it achieves its objective. Again, we see that high right there, its purpose was to break this law. Then it failed to break that law. Therefore, this one is going to be weak. And what do we see? Price will respect it. And that is what is going to be happening over and over again until once price breaks the law. Let's say it breaks the law like this. All right. So now here we begin, like I said at first, we begin to think in what? In terms of possibilities. Okay. We begin to think in terms of possibilities because now we can see that one law has done what? Has failed. Now here is the theory. Okay. Once one law fails, the understanding is that price is also going to do what? Once one law fails, the understanding is that all the once protected lows are going to become weak. So here, this was a protected law, all right? So you can say protected, which has become weak. So protected. So this was a protected law. Okay, come on. So you can say protected law. Let me add law right here. So protected law, and also this was a protected law right here. This was a protected law right there. And also this was a protected law until the origin of the move. So all these were protected laws, meaning that the liquidity that was lying down here was protected. The liquidity that was lying at the top was targeted, right? So price took out that high, protected this one, 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 etc., etc. Until we see if the protected law fails. So we say protected law fails, right? So this protected law fails. What will become of all these protected laws? They'll become weak, right? Until one proves to be strong, okay? They'll become weak and they'll become areas of reaction, right? To either fuel or pull back. Some, unless they are strong enough to create what? To create, like maybe let's say price comes here and this law, which is right here, all right? Unless when price comes here and then let's say this law right here becomes strong, and then once it becomes strong, then we see, and the proof that this law is going to be strong, because now what is going to happen here is this high has become what? Protected. Okay, so this high has become protected. So you can say protected high. So that high has become protected. So if this law fails, this high automatically becomes protected because now that high has managed to break the law. It has become now protected. Okay, so for us to regain the original trend where protection comes back to the law. So now price, we know that this law failed. This becomes a weak law, all right? Because one law has failed, which was once protected. All the laws are going to become weak laws. But then if this one wants to become strong, then we want to see buyers protect their interest on that law, then continue pushing price to the upside. So again, if this weak law, which now became a weak law, manages to take out the protected high, then what do we have? We have again a protected what? A protected law. Okay, so now
and if this law then is protected, does that mean that all the other laws become strong again?
Yeah, exactly. That means
okay.
yeah, it means that if this low becomes protected, then all these, then they'll remain protected. Okay, because it has then failed to, it has managed to take out the once protected high. So meaning that all these again become protected as it were. Meaning, just like we were talking about the sweep of liquidity, etc., etc. It's just another way to explain the same thing. You understand? So they become protected. But if this low also, because now we are not going to be looking at structure will change. Even when it comes to drawing your structure, you're not going to say low, high, higher, low. Let me use maybe a marker. So you're not going to say it will change. So it will be a low, high, a higher low right here, a higher high right there, a higher low right here, a higher high right there, a higher low right there, and a higher high right there, and a higher low right there, and a higher high. So you completely
yeah. This becomes internal structure then.
Yeah, it becomes internal structure.
Yeah, so it is the same as this.
Exactly. So that's how now your new structure is going to be like. So meaning that this law was still protected, and this now became your new range, and price came back, put into that area, and then we regained its structure, and then continued giving us protected high lows and targeted highs. Okay. However, if that then fails, okay, which means that all these protected. So if price respects that high, all right, it respects that high as a protected high, then what does that mean to us, and what does that tell us now? What that tells us now is that all these lows are going to become areas of reaction. Let's say price can come here, reacts, pulls back, then pushes all the way to the downside, again reacts, pulls back, and then the market continues. So meaning that now what will start happening is that price will start now creating what? Protected highs, and protected highs once one low fails. Okay? You understand, right? So all these lows that were once protected, they'll become what? They'll become, they'll become weak lows. Right? All these will become weak lows. So they'll become failed lows, and failed protected low, failed, and they'll become weak lows, in short. And they'll become areas of liquidity to target. Yep. That's how it's going to be. And while we are still looking at the same concept of protected highs and protected lows, okay, let's look at it again. So while we're still looking at the same concept of protected highs, and let me just try to zoom in a little bit. Okay, so while we're still looking at the same concept of protected highs and protected lows, there's a situation, again, or a scenario that would happen where price, I don't know why I like using a bullish example. Let me try to use a bearish scenario. Price pushes to the downside, right? Pulls back, and then pushes to the downside again, and then pulls back. So we know that we are putting in strong lows, strong highs and weak lows, right? So right here, the moment we break structure, we are downtrend, all right? So the moment we break this low, we are downtrend. Okay, so the moment we break this low, it's a confirmed downtrend because we have one high, one low, second high, second low, confirmed downtrend. And we can see that price keeps taking out what? It keeps now breaking lows, and it is respecting highs. So meaning that this high is protected, this low is targeted because it failed to take out that high. So therefore, we run it. All right, this low is weak because it has failed to take out that high. Therefore, we're going to run it because that high is protected. It managed to take out this high. So we don't expect it to be run. Therefore, we respect it, and etc., etc. So that's how the market will keep on printing those new highs and new lows, new highs and new lows, etc., etc., until one of the lows fails to hold. So now, in this situation, let's say we have price is now pushing to the downside, and as we see price pushing to the downside, it begins to push, to the upside, then it begins to push to the downside, then it fails to do that, then it's the same scenario. We looked at this example, right? We looked at this example. So it's the same scenario. So we have this kind of a situation right here. We have this low right here, which is a targeted low, and we have that high right there, which is a protected high. All right, so price is here. All right, we put back and we created the low, which was supposed to be a protected low. Then price began to push to the downside, creating lower lows and lower highs on the lower time frame. Then what happens? The market failed to take out this weak low. Right. Yeah. So if this high fails to take out this low, what does that high become? It becomes weak. So this now becomes a weak high. Right. So it has become weak. So it's a weak high. We are still looking at this range. So this is still our protected what? Protected high. Right. Protected high. And what happens now? This high that failed to take out the low becomes weak. And then if it becomes weak, it is going to become what? Targeted. So you can see here, it has even become targeted high.
But if this high becomes weak, didn't we say all the other highs also become weak?
No, they're not going to become weak. Why? Because they're still, it's about the range, all right? It's about the range. So we're still in this range and in this range.
Yeah, this one has to be broken. Yeah, I understand. Okay. Yeah.
So it's the same example that we looked at when we were looking at swing structure, swing highs and swing lows. Remember, it's weak swing.
Yeah, I think the important thing is to stay or to always to look at whether the minor structure or the major structure and not mix up both. And yeah, this is what I was doing here, because this is internal or the minor structure, and of course that does not mean that the major structure high here is already weak. Yeah,
exactly. So what now you're looking at is just a minor structure, internal structure, because sometimes internal structure may be, sometimes it may take long for internal structure to fully complete and give us a new swing. All right. So this is also where I used to have a lot of problems and troubles understanding my swings and my structure. And I had to put in a lot of work. Like, I think it took me 1 year and some months in order to understand these concepts that I'm sharing with you, because it was quite hard, more especially that, I was just doing it. It was more of self-taught. So it was quite hard, browsing through the YouTube. You look at this guy, trying to make sense of all these things.
Yeah, I mean, this is really a problem, because there are really not many guys out there that teach structure properly.
Yeah, exactly. So it's a very sad experience.
Yeah, and I mean, in ICT, meaning this is already a market structure shift here.
Yeah, it's already market structure shift,
because this is a failure swing. Yeah.
Yes, exactly. So that's a market structure shift, and we'll also we'll look at that in a separate market structure explanation. Like for me, I like to take it. I like to expand it, and I don't want to mix all the concepts together.
Yeah. That's good. That's really good. I really appreciate.
So that now you begin to understand, when you see it, it would just be like the whole market structure would just, become so naked to you, like you can just see it for what it is. Okay. Yeah. So we are still, so if you look at our trading range, we are still looking at this high. So this is still our protected high, and this is still our protected low. All right, so this is where we are in the market. We have that high and we have this low. All right, now price put back to create that lower high. Then this lower high failed to create a lower low.
Is this low really already protected? Because
it's it's a targeted low. Sorry if I said protected.
Yeah.
So it's a weak low.
Yeah.
Okay. Yeah. Sorry if I said protected. It's a weak low. So this low is weak, but then we begin to see internal structure. All right, internal structure begins to do what? So this one now, it becomes internal strong low. Okay, so internal strong low. All right, internal strong low, that is this low. Why? Because now it has taken out an internal weak high. So now this one now becomes internal weak high. All right, that's how it becomes now. So it becomes internal weak high. And for us to really, because this kind of a complex structure, all right, once we start looking at complex pullback, because from here we'll look at maybe two types of pullbacks. In fact, two types of pullbacks and two categories of pullbacks. Okay, so to understand, the market structure in depth.
And this is also the reason why this is still protected and this is weak. That means if price still wants to go down, this is exactly the area where it takes out this one to go down then.
Exactly.
This is really interesting.
Now it's making sense, right?
Yeah, pretty much.
Yeah, exactly. That's what I want you to see. I don't want you to get to a point where I start thinking, oh, what is this? Is this market structure? What is really going on? I want you to see it for what it is. Okay, so we are still downtrend, because what can happen is the market can still sweep that and break that internal strong low, because that internal strong low is not as strong as this external protected high. Let's see. So there's internal and there's external. You get
and also this low is still weak.
Exactly. It's still weak. It's still weak. It's still our target. It's still our target. And we are going to have this kind of a move. All right. But then there will be some that will be looking at this to say, okay, this is now the market structure shift. For me, if I'm looking at the market structure shift, if I see this one to say, okay, this is a failure of the swing low, creation of the swing low, I don't want to make assumption and start saying, okay, what are we going to do? Are we going to do this? If I want to trade the higher time frame, but again, I'll still explain this. All right, I don't want to go ahead of myself. I'll still explain this. All right, but I'll still want to see the failure of a external protected high or protected low. All right, because that
makes sense.
Yeah, it is going to give me now a clear bias to say, okay, now with this kind of a structure, because a complex pullback in most cases leads to reversals. That's what I've observed. All right, and we'll look at that. Okay, so this is what protected highs and protected lows happen versus internal structures. So this is going to be an internal weak high. This is going to be an internal strong low. Then that is going to be an internal weak high until if price then breaks this one right here. All right. So price breaks this one right here. Okay. So let's say this was a strong internal strong low. Now we break it. You get it? We break it. So this one becomes internal strong high. You see, this one now becomes internal strong high. This becomes internal strong high. Now, if it becomes internal strong high, it will only become internal strong high for as long as price just manages to take out internal strong low. You get it? So if it manages to take out internal strong low, it is internal strong. Now, the moment price also takes out external weak low, all right, which is now this one here. Right. So it now no longer becomes internal strong high. It becomes just an external strong high. So it becomes a strong high. Right. Now that it has managed to do what? To take out the external strong high. Okay, like that. Okay. So that's how now you begin to look at the market structure. Okay, and sometimes just while explaining here on this one, there is also this, let's say this internal weak high. All right, let's hold on to this idea. We're not going to change anything here, but I'm just going to, adjust something right here. So let's adjust this. Let's say this is right here, and we say, okay, let's just adjust this. Okay, so I want it to become so messed up so that you can, if you can explain this, then
I think so. I think so. Yeah, yeah. Because if this happens, we still have the break of structure here and also here, which means this strong high is this one here now.
Which one? Exactly. That is going to be a strong high. So others would want to say, no, it's this one, because they would say this one failed to take out the low. You get it? Then price.
No, it did not. It did not, because this is more or less one swing.
Yes, exactly.
Yeah.
So that is how to now begin to decipher the market structure.
Yeah. This is really cool.
Yeah, that's how you decipher the market structure. And once you get to that point, there's nothing so complex about the market structure that you're not going to fail to understand or solve or sort out. Okay. Now, the next thing, I know you're going to apply this information on the charts, and it will be so amazing. Now, the next information is what is going to give you more of a breakthrough understanding about the market structure, combining all this information that we have looked at. So the next thing that we're going to look at is two types of pullbacks. So I'm going to call them categories and types for the sake of my explanation. All right. So we're going to look at two types of pullbacks. All right. So two types of pullbacks. Now, different traders, smart money traders have got a different understanding and explanation of what market structure is and what they consider to be structure, what they consider to omit as structure, etc., etc. For me, I'm going to give you the raw information and take it as it is. It is something that is going to help you. All right. By the way, I've backtested this information at least on about 2 years, 6 months of data, Nasdaq, and it came out 82% win rate. So it's something that I know very well, that even though it has some failures, yes, it has failures.
82% win rate with which risk reward ratio? I mean,
the risk reward ratio is 1 to 5.
Oh my God, that's amazing.
Yeah.
Oh, this is really a lot. Okay.
Yeah, exactly. So it's something that, sometimes I would go for a week without taking a loss. Sometimes I would go for a week taking 5 trades, only losing 1 trade. Yeah, it's something that I've seen over and over and over and over.
Yeah, I think sometimes you can also have some losses in a row. This is just what happens also with 82% win rate. This is just statistics.
Yeah, it's just statistics. So you can have some losses in a row, but we're looking at the larger sample size. In the end, you end up being profitable.
I mean, 82% is really much. That's a really successful strategy.
Yeah, exactly. So let's look at the two types of pullbacks. And now in these types of pullbacks, we're going to look at number one. We're going to look at a deeper pullback. And number two, we're going to look at shallow pullback. All right, so we have two types of pullbacks. Number one, a deeper pullback. Number two, a shallow pullback. All of them are pullbacks. The first thing that I came to understand and I came to agree with after, looking at the market for hundreds of hours, I came to a conclusion that market structure is and will never be perfect. It will never be what we want it to be. For the fact that I'm not the one, if I was the one moving the market, I'm sure I would create a perfect market structure because I love perfection.
Yeah, the problem is everyone would get rich then.
And everyone will get rich. That's where the problem is. You get it. So we are dealing with an environment that is not perfect. We're dealing with an environment that is not certain. And we just have to accept whatever the market gives us without having to strive with it. Just accepting it to say, okay, this is what the market has for me, and it's okay, I'll get it the way it is. So we have two types of pullbacks. We have a deeper pullback and we have a shallow pullback. So when the market creates a high, a higher low, and a higher high, this is our basic template of what? Of a confirmed trend. All right, this is our basic template of a confirmed trend. So now that we have a break of structure and we're a confirmed trend, the next thing that we need to expect the market to give us is a pullback. All right, so once the market just breaks above the previous high, all right, begin to expect a pullback. When it's going to happen, no one knows. All right, but we can of course begin to look at maybe previous areas of interest which price maybe did not mitigate, etc., etc. Maybe we can start looking to the left and start creating some narrative to say maybe obviously because of this maybe supply zone or demand zone, more especially supply zone that was not mitigated, price would use that supply zone as what? As a catalyst to initiate a pullback. So we can start now looking to the left, of which I used to do a lot. I don't do now, but it's still effective. You can start looking to the left for those unmitigated areas, because that's where we can start seeing maybe price begins to create some pullbacks before we can see the market push to the upside. And we'll look at this more in depth once we start looking at supply and demand. All right. Okay. So let's assume there's an unmitigated supply zone. Unmitigated supply zone that price left and never put back to, and price hits that level, and that level is going to initiate a pullback. Now, pullbacks come in different types. So we have what we call a deeper pullback. And what's a deeper pullback? A deeper pullback is that pullback which price pushes all the way to the downside to almost the origin of the move that led to the break of structure. So we see price push back to almost the origin of the move that led to the break of market structure. All right, so that is an example of a pullback. So we have this as a break of structure here. So if you're that guy that would want to say, I trade OTE, which is optimum trade entry, that would be one of your good entry, the OTE, the optimum trade entry. It would be one of the good entry. But you will realize that with the market, it's not every time that you're going to get your OTE kind of trades. It's not every time. You see, so since knowing that it's not every time that we're going to get our OTE, then we need to now begin to look at the other type of a pullback that will happen. So sometimes price may come too overstretched, too overbought, such that price still pulls back, but the pullback is rather shallow and the market continues pushing to the upside. Now, much of the confusion that comes in is where you disregard this as a pullback. All right, that's where the confusion comes in, because for you to remain consistent, you need to always disregard this as a pullback, and you have to then look at this leg as one leg. You get it? You have to look at this leg as one leg. If you are going to disregard this as a pullback, because it is a shallow pullback, then you might as well look at this one leg from here to that as one leg, and then maybe put this one as internal structure, which sometimes may become so messy and complex. You see, it becomes so messy and complex, because what the market may do next time is that it may still make a deeper pullback, like it will come down here, and this is, according to that range, this is going to be a deeper pullback and price will push to the upside. You see. So now the question that you're going to have is, if you disregard it as structure, all right, then you might as well ignore the fact that price is pushing back to this area and then it begins to push to the upside. So what we have here is that we have a deeper pullback, all right, and as we can see, we have this low right here, and price pushed almost closer to the entry or closer to the origin of the move that led to the break of structure. So this is the origin of the move that led to the break of this structure. Price put back to that area, most close to that area. And again, we saw price break structure to the upside, leading to the break of structure. Again, we see a pullback, but this time around, this pullback is far away from that the previous move that led to the break of structure. So you can see it's a pullback, but it's very far away. Therefore, it's called a shallow pullback. It's not deep, it's just a shallow pullback. Then
yeah, but it could also happen that we see a shallow pullback followed by a deep pullback.
Exactly. Exactly.
Because this is basically what we see here. We have that shallow pullback here, and then we move deeper to the deeper pullback.
Exactly. So yeah, exactly. So now this is where I was telling you to say it's not always, all right? It's not always, unless you consider this as your one move, then you can consider this as a deeper pullback. So how do I work around this kind of a confusion in the market? For me, what I do is I take structure as it comes to me, and I work with the assumption that the market structure is not always going to be perfect. All right. It's not going to give me exactly what I need. So I have to adjust to what the market is presenting to me if I have to remain profitable in this market. All right. I have to adjust, right, rather than fight with what the market is doing. Okay. So there are two possibilities to your what you have said. Price can do this, okay, give you this deeper pullback, and then continue going to the upside. All right. And this is where now you're going to consider this as your whole entire move. All right.
Yeah.
You're going to consider this as your whole entire move. Okay. But then there will be a situation, because this is not going to happen every time. You understand? This is where now you need to start thinking in possibilities, because it's a matter of possibilities now. All right. This is not going to happen all the time. So if you are going to be trading that, then always, when you have a shallow pullback, wait for it to be run. Okay. Then if you have that, then you're going to be trading, you're going to be catching trades. But again, not all your trades are going to take profit if you are targeting this high. It's not all your trades that are going to be hitting take profit if you're targeting that high. I believe you understand what I'm talking about. So if your entry is here and you're targeting that high, like this high right here, then it's not all your trades that are going to be hitting take profit. Why? Because of the possibility that it may be initiating a reversal.
Yeah, of course.
You understand? So that means you have to always treat your shallow pullback as a minor pullback and nothing more. Minor pullback and nothing more. Meaning that you don't really trust that price could come and use this area. You consider it as liquidity that the market must run. Okay? Are you following what I'm saying?
Yeah.
Okay. Then if you put that in your arsenal as your rule that you have to follow, then completely omit this trade. So this trade is not going to be your trade. Even if the market comes and gives you that buy, you're not going to be moved by it, because you know, okay, this is not my buy that I was expecting. You get it? But then if you follow, my methodology is, this is a deeper pullback, this is a shallow pullback, but to me, it is structure. Okay?
Yeah.
To me, what? It is structure. And if I treat it as structure, all right, then I'm going to use a tool. I don't think I'll have to explain so much about the discount versus premium tool.
Yeah, I know this.
Okay. So I'm using a gun box. All right. So
okay. Because you don't need to look at the optimal trade entry or something, or so you're just interested in the 50%.
Yes, for now I'm just interested in a 50%. Okay, so for me, a deeper pullback is one where price crosses the 50% to the downside. So if I put my gun box like this, all right, this is my trade, I would be looking for trades, buying opportunities in this discount area. All right. But then if I put my gun box in this next leg, this range right here, I'm a guy who loves trading in my discount. You get it? So if I see this pullback happen and then leads to the break of structure, I'm going to ignore it and say, okay, price never put back to my discount. Therefore, I'm not going to take any buy right here. All right. That doesn't matter what time frame I'm looking at the market, but as long as that is what I see on the market, I'm not going to consider that as a trade. I'll let it run. I'll let it slide. I'll try to sit on my hands, right, and try to ignore what is happening, or maybe try to find something else to do and distract myself. So I'll say, okay, I'll let that pass. All right. Then I'll still follow it religiously. The moment I see the next break of structure, I'll put my gun box, and guess what? I'll be waiting for price to pull back into my discount. Now here, once price pulls into my discount zone like this, I have to also know for the fact that, okay, I'm dealing with a shallow pullback. It is still structure, but I'm in a deeper pullback of a shallow structure. All right. I'm in a deeper pullback of a shallow structure. So this higher low and higher high, it's a shallow structure, and price is pulling back. So I'm in a deeper pullback of this shallow structure, which was caused by a shallow pullback. So I'll be looking forward for some buying opportunities. Also knowing that in my previous range, right, we had, let's say, we had a discount zone that was not mitigated.
Yeah.
Okay. So my expectation here, I'll be open-minded because I know this may fail and they may run this as liquidity, right? To come here and then continue with the push. But the mistake that I don't usually make is to anticipate that the market is going to run this low.
Yeah. I mean, this low is protected, and also you have this this reversal pattern here,
exactly,
which is our Quasimodo pattern, which also produces minor protected lows.
Exactly.
And I mean, if you don't see this one, then it could come to this one and then give you this.
Exactly. Yeah, exactly. So that is what I'll be looking for. You know, it makes work easy, because if I take a loss right here, I'm not going to be so hard on myself, because I knew, okay, I was open-minded right here. I still considered it as a structure, but if it fails, I still know that in my previous range, I still have an unmitigated discount zone. So this price can come here. But when will liquidity be run? I don't know. All right. Back then, I used to anticipate run on liquidity, and I got frustrated because what I was expecting the market to do, it wasn't doing it. So you can imagine.
Yeah. I mean, even this one, you also have liquidity being run. You have this one that created inducement here, and even this one here was run by this one here.
Exactly.
So it's not like you have nothing there, but it is just at a different at a different position.
Yes, exactly. And that's how, and in fact, if there's that run on liquidity, like we have liquidity right here, we have liquidity, I even have a reason to even buy right here and try to take the market to the upside. Okay. So that's how I would look at the market. But if it fails, it's just one loss that I would take. And then I can still look for lower time frame entries and take the market to the upside on this zone here, or on the extreme zone, which may come down here. But also, if that happens, I'll still be open to both buys and sells, because I know we have one high and one low. It's not yet a confirmed downtrend, so it could be just a sweep of this external liquidity in order to get something right here, and the market continues pushing.
I mean, the interesting part about this one is if this one here fails you, that means this zone has to fail you, and also the Quasimodo pattern has to look like this and then fail you. So there's the need for two failures of patterns that happen here, and it might happen sometime, but I don't think that when you look at this pattern at this position here, that this one will fail you.
Yeah.
Because if this whole move does go down here, this pattern would not be there. So this is our additional confirmation that we use here.
Yeah, so that's the additional confirmation, and that's why we need to look for confirmation on the lower time frame.
Yeah.
Exactly.
I like this.
Okay. So that's how I look at the market, and try to keep on, creating crazy structures just like that. So the most important thing is your understanding of how you can, qualify that structure, more especially Nasdaq. Nasdaq is more of a buyer's market, so it pushes impulsively. So sometimes you look at a move that is happening so impulsively to a point that you start thinking, okay, hey, what is happening? Is the market leaving me, or what is really going on here? So sometimes you may throw away your rules and start chasing price. You get it? So patience is always necessary, and understanding your rules that you are dealing with, that you're working with, in order to always execute your plan flawlessly.
Yeah,
exactly. All right, so the next type of pullback, so we have dealt with deeper and shallow pullback with the help of a gun box to help us understand which one is our deeper and which one is our shallow pullback. So for me, any pullback that does not cross the 50% is a shallow pullback, but it is also going to be regarded as structure. I'm not just going to throw it away and say, no, it's not structure, because Nasdaq is quite different with other assets, like, more especially indices. They're quite different from currencies. All right.
Yeah,
so indices are very volatile. So sometimes it may become difficult for you to even classify what structure is. And once we go to the chart, I will show you sometimes what you consider to be a structure that may not hold. It will surprise you how it will hold the market. And
but would you say that the indices themselves, like Nasdaq or SPX 500, that they work most of the time similarly regarding the moves in the structure?
Yes, they work similarly.
Okay.
They work similarly. Exactly. They work similarly. So you can get this knowledge and apply it on SPX, and you still get the same results. Apply it on US30, you still get the same results. They work similar. They're just different from currencies in the sense that they are very aggressive, and when they pick a direction, sometimes they'll move in one direction, giving you 400 points in one direction before you see a pullback. You see, so there are such kind of markets. Okay, so this is where, even when it comes to looking at structure, you really need to adjust the way you look at structure. Many traders who migrate from currencies to indices, they have a difficult time trying to understand what structure really is, because of the behavior of these moves, of these markets. Okay, then the other type of structure that we're going to look at, the other type of pullbacks, or the other category. So here I'm going to say categories, two categories, just to distinguish what I'm talking about. Two categories of pullbacks. Now, the other category of pullback, this is where we have a simple pullback and a complex pullback. So I have simple pullback, and then we also have complex pullback. Right, so simple pullback and complex pullback. So what's the difference between these two? Okay, let me get a selling pattern this time. So we have a push to the downside, a pullback, then a push to the downside. At this point, what we are having right here is, we are having a, let's say BOS, we are having a confirmed downtrend. We have a high, low, higher high, lower high, and lower low. Now, A simple pullback is where you're just going to see candles stack on top of each other, right? If they are bullish candles, you just see bullish candles stack on top of each other, and then price will break structure to the downside. All right. And for a complex pullback, you may begin to see, let's say if you're viewing this on 1 hour or H4, you begin to see another trend developing. Okay. As the market begins to pull back. And the difference is that complex pullback may really take time to develop. Okay. And after a complex pullback has finished, it will still also take some time to go and break structure. So what we were looking at when we were looking at, swing structure and weak highs and weak low, weak highs, strong lows, and strong highs, weak lows, it was much of it was complex pullback. Okay, so we have a break of structure here. Okay, what's the time? I think we need to be done by 9 p.m.
Okay.
Yeah. Okay, so what we have right here, you can see here, it's a simple pullback like that. And I'm not necessarily saying that maybe you go to a lower time frame and you start looking at what the market is doing in the lower time frame. That is a different time frame altogether. Okay, so that's a different time frame altogether. All right. Within the same time frame, you're viewing your structure. Once you begin to see a structure beginning to develop, it might be a substructure. Like in this example, this is a substructure where you begin to see a substructure developing. All right. With the same time frame.
But I think you always have this kind of structure. I mean, even when you look at this one here, this also looks like this one and going down. So what's so complex about this one?
Okay, this one is not a complex, it's a simple. So what I mean by a simple pullback is this. Let's say we have, these are, let me change the color. Let's say these are bullish candles pushing to the upside, all right, in the pullback, in that pullback. So what you begin to see is that you just see bullish candles stuck on top of each other as price.
Okay. I understand now. So you don't have something like this, what looks at the less as a break of as a change of character here, which then is not a change of character and just pushes more up, and then you have a change of character that is a really change of character, and so on. Yeah,
exactly. That's a complex. So you can see that right here we began to break structure. Here. All right. So the moment we break structure right here on the lower time frame, you can even get your gun box. You can even start treating this as a trend on its own as you are pulling back. So you can initially you are looking at this higher time frame structure. All right. You're looking at this higher time frame structure where this is the protected high, this is the targeted low. But also, as price begins to pull back, it begins to give you protected lows, targeted highs within this same range.
Yeah.
And you can take these trades, you can start buying the market, you can start playing the pullback, you are buying, you're counter trending, you're trading against the trend, all right? Following the structure that is developing. If it is at 1 hour, you're viewing the market. Let's say this is 1 hour structure. You begin to see this 1 hour pullback begin to form a structure as it is pulling back.
Yeah.
And that structure is tradable because you can identify structure and you can identify swing structure and swing lows and swing highs, as you can see. So
exactly. You just need to know where in the market you are regarding the overall structure and what the market is going to do.
Exactly. So this is an example of a complex pullback. And maybe just to on this one, I love showing an example because I can't draw this using candlesticks, using this.
Yeah. It's okay. It's okay.
Complex.
I understand now what you mean. Yeah.
Okay. So let's go here. And
in general, that means the most pullbacks or the most moves are a bit complex.
Yeah. But even simple pullbacks are there. All right, even simple pullbacks.
Yeah. I see here. Yeah, this one looks quite simple. No, maybe even not, because you have this one here, and then price goes down.
Yeah, exactly.
Yeah.
So if we started, let's start from where can we start? We were in a downtrend, so we were breaking structure. So we had a lower low, lower high, lower low, lower high, lower low, then shift in structure right here. Then we created a higher high, higher low, higher high, higher low, higher high, higher low. So you can see that right here we had simple pullback.
Yeah.
Simple pullback. You can see how candles are just, stacked below each other, right? Simple pullback. Even this one candle here, it's still a pullback because price pushed, then created this pullback, then went all the way to the upside. Okay, that's a pullback. And we come here, can see this one is quite clear. It's a simple pullback. You can see how candles are stacked below each other. All right.
Okay.
We can come here. What's this? It's a simple pullback.
Okay. Yeah.
You get it? Even right here, even though we have one candle which goes to the upside, but it's not structure which can be traded. All right. Here, we have only one bullish candle going to the upside, but we can't say this is a structure that can be tradable. But let's look at this one here. All right. So firstly, we need to look at this range from this low here to that high. All right, what do we have here? We begin to see that we have structure. Okay, so we have that high, that low, a lower high, a lower low, lower high, lower low, lower high, lower low, a lower high, and a lower low. Okay, so what's this? This is now a complex pullback. We are pulling back, but in a complex structure, in a complex manner.
Okay, yeah.
You get it. So this one is tradable. You can trade this one, even on lower time frames, you can still buy this market to the upside. So begin to observe that we begin to create structure, which is actually tradable. You can take some buy, some selling opportunities. Let's say you sold at this extreme supply right here. Price dropped to the downside using lower time for confirmation. You come here, price push back. You identify a supply break structure. This is what I was saying, a deeper pullback. We have a very shallow pullback here. We have another deeper pullback. In the context of this shallow pullback, we have a deeper pullback because price comes almost to the origin of the move. Then we drop to the downside. And then what happens? Price then gives us an unconfirmed buy. All right, it sweeps liquidity on this high, on that high, and then it gives us that high. Then what happens? Price continues, regains its original what? Trend to the downside, and we can see that we broke structure to the downside. And after we broke structure to the downside, we have again a push to the upside. In short, we regain the original direction of the market. And again, you can see that as we are coming out of this complex pullback, we also take so much time to rise, because as price is rising, it begins to react with all these areas of interest which were not mitigated, like those unmitigated supply zones that we're going to talk about. So price begins to react with them, creating these pullbacks, right? Pullbacks, push to the upside. Again, we pull back into this area. Again, we break structure to the upside. Again, after we break structure to the upside, we have this higher low and that higher high right there. Then what begins to happen? Price begins to create some form of a complex pullback as we are getting into this lower highs, higher lows region, right? And from there, price then begins to push to the upside, again, breaking structure. Again, from there, we see we have a simple pullback. Again, another simple pullback right here. Here, we started creating some form of a complex pullback, as you can see, until we push to the upside. All right. So the market is made up of complex pullback and simple pullback. Now, what I've observed with a complex pullback is that price uses the complex pullback for two major reasons. All right. Number one is for price to maintain the original trend, which is if it was downtrend, it can give us enough time, gather enough liquidity in order for them to run that liquidity. And it will give us buy side liquidity versus sell side liquidity, which is this side. It accumulates that SSL, which is sell side liquidity or sell stop liquidity. So it will accumulate sell stop liquidity for price to come and run, right?
Yeah, yeah.
Price to come and run. And at the same time, it will be accumulating the buy stop or buy side liquidity right here, which can come and facilitate a pullback. So they use that in order to generate enough liquidity. If they have, maybe they want to push the market even lower, etc., etc. The other,
This one is buy side liquidity, right?
yeah, that's the buy side liquidity.
Okay, yeah.
Yeah, I made a mistake. Instead of writing SL, buy side liquidity, BSL. Yeah, so buy side liquidity and then sell side liquidity. All right, so they'll do that. And also sometimes they'll create complex pullback if they want to completely reverse the market, but without you seeing that a reversal is happening. All right, so they'll create that complex pullback. Let's say price was in an uptrend, creating high highs and higher lows, high highs, higher lows, high highs. Then they want to reverse the market. Then they'll give you a failure and then continue pushing to the downside. So they will create structure which they will now begin to follow, all right, internal structure until they break out of this external structure right here. And then once they break out of that external structure, then what are they going to do? They may now use one of the internal structures or one of the internal structural highs as the anchor for them to create a lower high, something like this, and continue pushing. So now this becomes the higher high and the lower high, the lower low, lower high, and lower low. And this is them flipping the charts and giving you that, reversal that happens. So you can even say, okay, this is a shift. You can start seeing the weakness by looking at that to say, it's the SMS, which is the market structure shift. You can start looking at this to say, this is, oops, what is it? You can start looking at it to say, okay, this is the SMS, which is the market structure shift, because you can see it's a failure to create a new high and then price to break structures to the downside until we see this protected low go. Okay, protected low go, then we are now going to say we are downtrend, but yet not confirmed downtrend, because again we can see price just come and run this liquidity, meaning that they were just trying to gather enough the sell side liquidity in order to come and do what? Run it after maybe they have run this liquidity down here and mitigated something down there. All right. Okay. Any question? I'm sure today have I tried my best to explain about market structure?
Yeah. This is really a lot of stuff, and it all seems quite logical to me. And I already know some things about market structure before. This is really comprehensive what you're showing me here.
Okay. All right. So yeah, and I think what we are just remaining with is multiple time frame market structure. And you are also, since you already know some of the things that we are dealing with, so I'll be giving you that opportunity to explain things so that as we explain, we argue points together. It's something that is going to cement this information into your subconscious mind so that you may not forget it. Whenever
That's
you
great.
see
it, yeah,
you know, okay, this is what we discussed and this is how I have to approach it.
Yeah.
All right. So before we go, there's one thing that I want to also assure you. All right, and it's that my mentorship, like we talked, as I love the confidence that you showed. Okay. I love
it maybe show like confidence, but I'm not that confident. Really?
No, actually, I'm talking about the confidence that you showed in me.
Oh yeah, yes, of course. I mean,
Yeah, the
I
confidence that you showed in me.
I really believe in you, and you showed me amazing things.
Yeah, yeah. So I was so much excited, and sometimes it would take me days to convince somebody. I'm in this industry to help, so sometimes it would take days to really convince somebody just to get to you to say, oh, okay, this and this and that. Yeah.
You know what really convinced me that fast was your video that you showed on your gig to advertise it, because I
Okay.
saw that you are teaching and you are talking in a very straight manner, and I mean, this is like I am. I mean, this is also something that is quite typical for German people. They are always said to be very straightforward and very need to yeah, like having being commanded to do something. And I really like this because it is really straight and plain and simple, and that's good. That's great.
Wow, thank you so much. And you're going to be, yeah, you're going to receive the best. Like I said, you are going to receive the best value.
Yeah,
Okay,
yeah,
so
and I'm
even
really sure that all the magic of the trading and how we do it, the really the secret is really in completely understanding the market structure
yeah,
in
that's where
its
the secret
deepest.
is.
Yeah, and
Yeah. And I can almost assure you that if you understand, for me, I invested much of my time understanding structure. I wasn't so much concerned about supply and demand, liquidity, because
yeah,
after I
yeah,
did everything together, market structure, supply and demand, and liquidity, I came to realize that liquidity is partly market structure, because you can't have liquidity if you don't have market structure.
right, yeah,
See,
yeah,
and you can't have supply and demand and all those cost models if you don't have market structure. Then I asked to say, what's the most important component of trading? I came to realize that it was market structure. So what I did was I delved deeper into market structure, breaking structure into its different components and trying to
yeah,
arrange
yeah,
it and disarrange it,
yeah,
trying to understand it.
yeah, yeah, and this is also the reason why I asked you in your recorded course. You talked about this special market structure course, and I thought, oh, that's great.
Okay, yeah, that one is there, but I can give you, but it's still what I'm sharing with you. Most of the information is even updated, because you find that
Okay, okay.
it may even sound shallow if you went through it
Uh-huh.
compared to what we have discussed in this session.
All right, all right.
Yeah, it may
I
even sound
understand.
so
Yeah.
shallow, and you may be wondering, say, that what we did is much deeper than what he explained in that market structure. I have it. I have
Okay,
a,
okay. No, no. Then I think then I don't need it if this one is already going deeper here.
yeah, this one is deeper than what I've explained in
Yeah,
that.
yeah. Then it's okay. Mhm.
All right. So this is where we end. So in
Yeah.
case, because I've seen the gig will be expiring soon, the delivery. So
Mm.
if I request that you approve the delivery, don't worry. I'll still continue having sessions with you. Okay.
Yeah, that
I'll
would be
still
great.
continue
Mhm.
having sessions with you, because I have clients that I delivered their gigs a long time ago. Like, just to give you an example, this guy, I delivered his gig some months ago.
Mhm.
All right, somewhere in April, that's when I delivered the gig,
Mhm.
and I've been mentoring him up to now.
Oh,
Okay, so you
nice.
don't have to
Yeah.
feel like the moment I deliver your gig, then I'll disappear. No.
Mhm.
All right. Yeah, so our relationship still continues even after the gig, expires, the days come to an end and all that. Our lessons will continue, and we'll continue having our lessons. So this guy, the gig was completed on the 17th of April, as you can
Mhm.
see right there.
Mhm.
But I still have lessons with him. So this is 3rd July. We even had a market breakdown together, right? This was the
Mhm.
link that I sent him. You can see this was the link that I sent him.
Yeah,
Okay.
yeah.
And also this man here, I just want you to feel comfortable, all right? This
Mhm.
man also, today you can see 3rd what? July. But let's look at when I delivered his gig. Also, I think I also delivered it when 26th of June. Okay. And I'm still with him. We were having a session today. Another one is this guy down here. Also, today we have not had a session, but the last time we had a session was last week, should be Friday. And when did I deliver a gig? So I delivered his gig also somewhere 18th of June. Was it 18th? When? Yeah, 18th of June. And I'm still having, so I'll be having a session with him tomorrow, right? And also there are many, many that I'm still having sessions with, except that I've delivered their gigs.
Yeah, but your main source of income is still trading, right?
Yeah, my source of income is trading. Hello?
Yeah, all right.
Yeah, so it's I'm a trader. So that's what I do.
Yeah, you know that there are so many people on Fiverr or other platforms where you can buy courses, or they're mostly not traders, they're mostly teachers that pretend to be trading.
Yeah, for me, no. Actually, most of the trades, if I'm entering a trade, I'll even show you a screenshot to say, oh, I've taken a buy right here. I've taken a sell right here. You can take a buy, you can take a sell, etc. Like today, there was a buy that I've taken, except that the market was not just good because of the holiday in the US.
One last question for your performance. You said you had this 82% win rate, and you mostly have this 1 to 5 trades. How many trades you get like this in a month or in a week?
In a week, I only take 5 trades.
Only
5 trades.
I think 5 trades in a week is a lot.
Yeah, it's a lot. I trade 1 trade a day.
Yeah, I mean that's great if you still can maintain like even close to this and 1 trade a day. I mean, when I see these numbers, I think, oh, this guy is only taking 3 trades a month or something.
No.
This is so great.
Yeah, I take how many trades? I take sometimes like today's just that the market wasn't moving well, but let me show you. I took this on an M15. No, it wasn't that nice buy that I was expecting. Okay, so let me show you. It's just that today the market has closed too early. And this is where I tell you to say, for me, I take structure literally the way it is. So this was the break of structure that I had. And this was one of those OTE kind of a trade, which I took. So I had that break of structure. Then I took my Fibonacci, all right, which is for the OTE ones. And then I put it right there. And can see this is where I was considering to take an entry from. All right. And yeah, I took this entry and price just never, went to give me take profit. So let me show you the entry.
Okay.
Yeah, let me send you the entry on Fiverr. So I take these kinds of trades almost every day, depending with whether the setup, as long as there's a setup for the market, and these setups present.
I also looked at the market today just before we had our session because I wanted to see what is going on there, and I saw something different. I mean, I saw this one here, and coming back here to the extreme, and you could trade it from here and
or as a sell, right? Yes.
To the downside, yeah.
Yes. So I saw that one as well, although I don't know what's happening with the internet. Okay, it's coming right there. So I also saw that one. I saw that one, although you can check that one, although it is zoomed in, but you can see the entries right there. Now, although this one, I was trying to sell, but then for me, when I look at structure, I become reluctant because I follow, much of what I follow is major structure. So quite all right. So this as a structure, and there was something like this, and I was thinking, okay, we can take a sell right there. But then it would have been a pullback because the overall trend is to the upside.
Yeah. Of course, yeah.
So that's why I let this one run up to here, because price had just reacted on a 50%. and I let it push to the upside. And then if price had gone to break structure, maybe I wouldn't have taken a trade. But then the moment I saw price pulling back to this area, then I thought, okay, why not try a trade right here and see how it goes. So it's not one of those nice trades for today, but sometimes the market will give me 1, 2, 3 and I'll take it.
Yeah.
It's not every time that it will give me 1 to 5, but in most times in a week, it will give me 1 to 5, sometimes 1 to 7, sometimes even 1 to 8.
So in general, it is something like 1 to 5.
Yeah, so generally, if we put it here, it's 4.5. But if I target this high, it is even 1 to 6.
Yeah, 1 to 7.
Yeah, 1 to 7. Yeah.
Yeah.
So it's just that I'm out of this trade because tomorrow also it's a holiday. So I'm not going to consider.
Oh, it is? I don't know.
Yeah, it's Independence Day in the United States.
Yeah, of course. Yeah, for the future. Yeah.
Yeah, exactly. All right. So that's that. So
all right.
To have an amazing time together.
Yeah, it was really great. Thank you.
And thank you so much as well. You're welcome. And have a good evening. I think when can we have our session? When next can we have our session?
Tomorrow would be probably a good time.
Okay, so tomorrow I'll see how my schedule is going to be.
Yeah,
okay, I think tomorrow
you can text me. We can do tomorrow or the day after tomorrow or something.
Okay, if tomorrow doesn't work, then we can do Thursday.
Yeah. Okay.
Because tomorrow I may have a session because there's on Wednesday I may have a session at 9 p.m. here.
Tomorrow is Tuesday.
Yeah, tomorrow again, because tomorrow there's that guy from the US.
Yeah.
I may be having a session with. So let's see Thursday. But if tomorrow I'll still confirm with you.
Yeah. We just stay in touch and we'll do
same
something.
Time. All right.
I would really like to have more than one session a week because it is better to stay in the rhythm and do something and not forget about the things.
Yeah, exactly. So we'll be having at least 1 or 2 sessions every week.
All right.
Yeah. Okay. All right. Thank you so much and have a blessed evening.
You too. Thank you. Bye-bye.
All right. Bye.